back you look, the further ahead you can see. But I doubt even he could have foreseen the mess or the state that we've got ourselves into as we sit here 2011. Even 4 or 5 years ago, it would have been extremely hard to predict that at least 3 countries within the Eurozone are looking like they're heading for default or bankruptcy or some sort of a massive bailout. In fact, one's already got there. We've got countries in the Middle East and other parts of the world, North Africa, who are in the process of losing their governments, civil unrest, to put it mildly, some of which are being aided by NATO and other Western countries, others are not. But I think chaos is one word to describe what's going on in that part of the world. You've got General Motors saying that it's now getting more net income from its sales in China than it is from the US, and you've got gold at a level that I'm quite certain that no one would have predicted as recently as even 3 years ago. Certainly not Gordon Brown when he was offloading the UK's assets at $250 an ounce. What I'd like to try and do this afternoon in my allotted half an hour is to take a look at where I think and where JP Morgan thinks we are today, try and look forward, but try and do that through the lens of a business and entrepreneur rather than the lens I usually look through, which is from an investment perspective. We spend our days looking and trying to find good opportunities to invest in and where the risks are in markets. But I want to try and figure out what thoughts are on your mind and where we can help perhaps set the scene as some of the risks, some of the opportunities for business people such as yourselves. Before I get started, I'd like to do a couple of things. The first is to flag the fact that I am not an economist. There will be reference to economics in here. I think it was J.K. Galbraith that said that there are 2 types of economists. There are those that don't know, and there are those that don't know they don't know. Now, at the risk of massively having upset Mark with that comment, I shall proceed. The second point is that we spend all our days talking with our clients, and we have clients from a hugely diversified backdrop and background. Some are in industry, some are in finance, and we have a wealth of insights from our clients that we find extremely interesting and not unuseful. Now, whether it's been someone talking about an industry or someone having a very strong view on a particular financial market, as I said, that's extremely interesting to us, and I hope you'll indulge us if we ask you to help us out and answer a few questions that we've got for you. Because it's always interesting, and I think at this stage in the afternoon it's good to get you on the buzzers. Hopefully, on your table, you've got a little device with some buttons on it, looking something like this. And hopefully, we've got some questions that I'd like to kick off. What I want to try and do, though, is take the answers and apply them into the real world and see if there are any trends and themes that we can then sort of drill down into. So if we've got the first question, hopefully. And you've got to rank them, so you've got to force an answer here. So what business worries are sort of most keeping you up at night? Is it threats of competition? Is it cost concerns? Is it currency issues? Or is it for government policy uncertainty, including taxing? Well, that was obviously going to be the answer, but if you could try and rank them, that would be sort of helpful. So, far away. I'm asking which one most keeps you. It's always difficult with business people. Try. Most of our audience are just tuned in to sort of just whatever button. I mean, it's not. Don't take it too seriously. Just have a go at ranking which would keep you up most at night if you had to be force ranked. Just one. Okay, so that is indicating that most of you, or the majority, think that competition threats are their biggest concern. That's interesting, because I thought when we looked at this last night with a few colleagues, we thought that cost concerns might be right up there as the out-and-out winner on that one, but it's actually relatively level. Okay, let's move on from that. We'll come back to some of these, and the second question is looking at that whole cost side of things, which I must say I thought would be more on your minds, but perhaps not. But if you do focus on the costs, inflation, clearly a big topic, already touched on. It is one of the most topical things, and it's going to influence your business. I'd like to know where you stand on it. And some people are clearly going to be more worried about deflation than inflation. But that's one. Number two, I'm more concerned about raw material and input price increases. Number three, I'm most concerned about having to pay more for staff. 4, I'm most concerned that higher inflation will lead to higher debt costs, in brackets, interest rates. Again, forced ranking, please. Okay, so that is sort of handy because it fits in with what I was going to say later. Obviously, if you'd put something else, I would have figured a way around that as well. But it does very much tally with what a lot of our clients are speaking to us about. It's how to protect against inflation. We'll come on to that. There are some answers there. But also interesting that the raw material one wasn't a key factor. And I guess when one looks at businesses, unless you're in manufacturing, that's not such a deal. Although, as I'll show you in a moment, it's not just about wages. Finally, for now anyway, what is the priority for excess cash flow from your business this year? Reduction of debt, increasing dividends, maybe buying some shares back, reinvesting in organic business growth, mergers and acquisitions, or there won't be any, hopefully. Number 5 won't feature too heavily. Okay, so it is reinvesting in organic business growth. Well, that's, I suppose, what we'd expect entrepreneurs to be doing. And it's interesting when one looks at big companies that are quoted on the stock exchanges, that they are, I think, struggling to find the sorts of businesses that they can invest organically in, and therefore they are seeking to do other things with their cash flow, and we'll come on to that. At least finding businesses that have enough return on them to justify the investment, and they're finding other things to do with their cash flows. But obviously increasing dividends not a key priority, but maybe that's because of the nature of your businesses. Right, we'll park, that's the hard work for you done for the moment. We'll park that and move on to a few slides that I think might help us in understand where we are and what might be coming down the pike. And I know you've had a good session this morning on that from Mark with regard to macroeconomics and stuff. This is a fairly unambiguous picture, I think. There has been a huge improvement in economic activity since the bottom, which was about March 2009. And I guess it's not entirely surprising. The world stopped in late 2008. The manufacturing sector in particular just completely stopped. Consumption didn't stop quite as quickly, and then when we got through that horrible hernia that lasted until about March 2009, it became apparent that manufacturing stopped too abruptly, the consumption hadn't, and therefore there was a need to start rebuilding inventories and so on. Now, this is not a ubiquitous picture. This is the US, and you should understand that this is a survey-based chart. Anything above the line indicates an expansionary phase for the economy, and you've got the brown, which is the blue, which is manufacturing, and you've got the brown, which is the service sector. So from about the middle of 2009, everything was in expansionary phase for the US economy. Clearly, other parts of the world, very different scenarios. You've got Asia, you've got emerging markets where there was hardly a recession, if any, booming out there. And then you've got parts of Europe that are really still very much hovering along the bottom line and not in growth territory. So not a unanimous picture by any means. I guess other point to make is that it's not that unusual to see a recovery following such a steep fall-off. What is unusual is to see quite such a rapid recovery, and we'll come back to that in a moment. Of course, one of the things that comes with most economic recoveries is a better level of employment. As things pick up, companies become more profitable again, and they start hiring again. One thing that's been very absent in this economic recovery is a improvement in employment levels. There's been some, but it's been fairly late, and it's been pretty modest. And this chart gets to one of the issues around the employment, and one of the reasons that this recovery is somewhat different. We've got a chart showing a percentage of people's personal income that is paid for by different parties. Let me explain. The left-hand scale relates to the thick blue line. And what you can see is that the percentage of the nation's personal income that is derived from the government has gone from 1% in 1929 to about 18% today. In contrast, the percentage of a nation's personal income that is derived from its wages has gone down to the lowest level since the records began, at 50%. And this comes at a time where the percentage of profits that are wages in corporate America is at a 50-year low. So it's probably not entirely surprising that two things are likely. One, people are beginning to wonder just how sustainable this government expenditure is. And this is welfare programs, this is food stamps, this is Medicare, this is all of that good stuff. It simply isn't sustainable. I know Mark addressed this earlier on. So we're in full agreement. This is not a sustainable trajectory. It's also explaining why people are feeling so miserable about life. And although companies are in great state, actually the headlines and everything you'd see from a lot of people out there on the streets and Main Street is not a happy place. Again, this chart does not relate to other countries. There are certainly countries that don't have quite such a handout and culture. But I think the one thing that stands out about the States, and those that have businesses in the States will know this, is that this is one country where there has been no attempt so far of fiscal responsibility, of austerity measures, and so on. And it's part of the reason why the dollar is so weak. Companies, on the other hand, unlike some of the economies around the world, are actually in great shape. And I hope that all your businesses are in as good a shape as the corporate America and corporate world is, as you see it through the stock market lens. But what's interesting is the speed and pace at which profits have recovered in this last 18 months. This chart goes back a fairly long time, so it's got a bit of history to it, and it relates the speed of profit growth and recovery to that of economic and GDP growth. And you can see for about 30 years, the average is 2 times. Compare that with what we've seen this time round, and you've got a profit recovery that is hugely much more impressive rather than we've ever seen before. And in a word, it's productivity. It's because companies have been very disciplined in hiring new people as they've recovered, and they've used technology, and there is huge productivity gains still going on. The numbers would support this, such that they don't need, and haven't needed until now anyway, to hire lots of new workers. And I think this has implications for businesses because those that are employing technology are becoming productive and are seeing the benefits, understand it, whereas there are clearly those that are still wedded to the old models, and their margin deterioration is quite noticeable despite the fact that we've moved into this recovery. Again, another way to look at the good state of companies is to see what they're up to with their cash flows. As I mentioned earlier, my suspicion is that a lot of companies, at least on the big scale, are not finding enough major organic investments with a sufficiently high return on investment to justify doing it. Their animal spirits certainly haven't been, until very recently, particularly high. We're now seeing a little bit more positive optimism on behalf of the CEOs and the CFOs. And that's manifesting itself in a number of different ways. On the top left-hand side, you've got the dividend picture. And as you can see from the chart, hopefully, the number of companies that are improving their dividends has doubled in the last 2 years. Now, this may or may not have any relevance to you, but it has a huge amount of relevance for investors. One of the things that investors absolutely love is companies paying high dividends. They love even more companies that are growing their dividends. And it is notable in the last 12 to 18 months, not only have we had a huge demand from clients who are fed up, frankly, in having the low returns on their cash and don't trust the bond market, which we'll get to in a moment, but also want to be attached to companies and shares of companies who own real assets, inflation hedging in brackets, but are also prepared to pass some of the profitability back to them. And the outperformance of stocks and shares, and therefore their companies, is marked. Those that are paying high dividends, and I'm not just talking about the sort of the utility companies, I'm talking about the mainstream companies, but those importantly who are growing their dividends are outperforming in stock market terms those that are not. So someone out there likes that, and that should be of interest to people as they consider what to do with any excess cash flow. Share buybacks on the right, top right-hand side. By the time we extrapolate the April to date figures, you're getting to a level of share buybacks that we haven't really seen since '07. People don't go and buy shares back unless they are supremely confident that they can spare the cash flow. They just don't. History is pretty clear on this. So something has changed in the last year to make people feel a lot better about life. And I think it's all to do with the profitability, despite all this headline risk and that we see around the world. Mergers and acquisitions. Obviously, JP Morgan has a pretty big corporate finance department. We see a lot of what they're looking like in their pipeline. And we don't see the detail, of course, but we know whether they're busy or not. And here you've got a chart that very clearly shows you that there's a huge improvement in M&A activity. Again, companies do not go out and seek to buy other companies unless A, they've got the wherewithal to do it, or B, they feel that they can afford the integration, distraction, and can benefit from what they're integrating with over the next several years. One chart that is interesting, and that's why I was surprised by the high response when I asked you about what you'd be doing with any excess cash flow from your businesses, is that CapEx has been notably lagging. And I think big companies are beginning to spend on CapEx, and they certainly need to. And one of our favoured sectors is technology. I know you've heard already a little bit about it. You're going to hear some more about it this afternoon. But it is true that there has to be quite a fair bit of spending on infrastructure, capital goods, and technology is all part of that. That's not just talking about to cater for growth in emerging countries and so on. It's rebuilding infrastructure in the West, and as I said, technology is a part of that. But a notable sort of laggard in where companies are spending their money, which I thought might be of interest. In terms of just staying on this dividend thing, because I think it is extremely interesting to investors, if not to businesses, if you were to plot on the left-hand side the earnings per share recovery, you would find that we are now back to '07 levels. So companies have basically made up all the lost ground. But on a dividend per share, they're nowhere near. They haven't reinstated their dividend. Now, part of that is down to the financials. People like JP Morgan are not paying out the dividends they once did. Some of them can't afford to. Some of them aren't allowed to. And that's part of it, because financials were a big component of the dividends out there. But look at the payout ratio on the right-hand side. Companies just are really not paying out what they can afford and historically have done. So you're right at the bottom of that trough. And I think it's very interesting to see when we look through companies by companies what people's intentions are, and we think this number is going up, and we think that is hugely supportive, by the way. All of these things are very supportive of the stock market. Stock markets love all this stuff. Staying with some of the costs that I thought you might be more concerned about than you perhaps are, and certainly the companies we talk to are extremely concerned. It is undoubtedly the case, or at least as far as I'm concerned, hard to argue that the inflation genie is not out of the proverbial lamp. And that's in part because of a lot of rubbing by Ben Bernanke and his cohorts. That is, I think, unambiguous. But what's interesting is that the US, and I'm using the US because it is one of the regions where there is the least inflation. In emerging markets, you already know that India's got rampant inflation. We know that China is having to tighten monetary policy to deal with the 5% or so headline inflation it's seeing, and it doesn't like it. A lot of the political unrest we've seen around the world in emerging markets is due to the high inflation, particularly food prices. But even in the States, which, as I said, is the last country to really see any changes, you are beginning to see some worrying signs. Around the world, the average CPI change year over year over the last 6 months has been about 4%. When you look further down the production cycle, you get much more alarming rates. And if you look here at the PPI finished goods on an annualized basis over the last 6 months, you're looking at an 8% number. If you look at and this is excluding energy, if you look at the raw or crude figure, so going back even further to the materials that go into those processes, you're looking at a near 40% year-over-year gain in the last 6 months. These are not small numbers, and they are there pretty much now in the open, and still the market is choosing to ignore them. So we'll see. We're obviously going through a bit of a soft patch at the moment. The deflationists have jumped on this. They've also jumped on the fact that wages aren't going up. And it's certainly very hard to argue that wages are a problem in the foreseeable future. There was an article in one of the press papers in the UK, I think last week, talking about the applications for 150 roles in the firefighting service. And there were 2,500 applicants for those 150 places. Well, that's a lot of people going for a small amount of jobs. So hard to argue that there needs to be wage rises. And certainly in the public sector, there's no money anyway. We've already seen that. In the private sector, I'm certainly not able to go to my boss and say my bills are going up, I need some more money. And I doubt many other people are in the private sector either. So I thought that was interesting. Sticking with inflation, this is another well-watched measure, the University of Michigan forward-looking inflation. And you can see there's a pretty good correlation between the CPI, which is in red, and the indicator, the survey, in the green. It is definitely picked up. And anecdotally, it was interesting that Bill Simon, the CEO of Walmart, came out last week and said that he had seen some pretty big cost increases coming through. You had Fed Governor Hoenig saying, again, recently, that he hasn't seen the sort of price acceleration that he's seeing in his part of the country since the late 70s and early 80s. That is, these are not small indicators anecdotally that something is changing out there. And yet, until such times as Bernanke and others want to really acknowledge this, and at the moment they're being very dovish and very much prepared to let this go through, then we're not going to see any meaningful change in monetary policy. You had Mervyn King out only yesterday talking about the UK, which has breached the 5% level or is about to breach the 5% level. Well, I don't know how many more quarters we need to be above 2% for someone to realize that this is not as temporary as perhaps it might have been suggested by Mervyn. So, again, costs are moving up. We know that commodity costs are booming, or have been until last week, and these charts won't be any great surprise to people. Agriculture, industrial metals, textiles. Agriculture, hugely important, and as I said, very much behind the political unrest in parts of the emerging world. Only 9% of personal disposable income in the US, 30% of personal disposable income in China. Authorities desperate to see some retrenchment in agricultural prices. I thought the chart on the right was pretty interesting as well. It was basically showing that the intentions of small businesses to push up prices is now rising pretty steeply, and it's about the biggest increase we've seen in intentions for 30 years. I think people had written off small businesses. They'd decided that the banks weren't willing to lend to them. They were down in the doldrums. You wouldn't see an intention like that unless something was happening. Either companies feel that they cannot wear the cost increase that they've had to absorb themselves any longer, or they feel they're able to pass through the prices, which in itself is sort of curious. I couldn't help but put in a chart of gold. I hope everyone owns gold. I hope they didn't buy it 10 days ago, but I hope they've owned it for many years. We've been big fans of gold. I'm still a huge fan of gold. It's a pretty impressive chart. Is it a bubble? Well, it's going to be a bubble sooner or later, and particularly if the sort of things that we heard about from Mark come to fruition. It's more about currency than it is inflation. It's about the fact that sooner or later there are going to be defaults in some pretty big headline countries, and it's not going to go down very well. And people are going to realize you can't keep bailing these people out, these countries out. And gold is a store of value that has stood a reasonable test in time, and we think it's extremely interesting. Of course, most of you won't have it as an input price, so it's not of interest to you from that perspective, like other industrial metals and other commodities. I've put commodity bubble. This is the Australian dollar, so it's not really fair, but it's very symptomatic of commodities and people's thoughts about commodities and focus on currencies. I can't think of a year in which there has been such volatility in the currency markets, and I've seen some horrible losses by people that have either tried to hedge out their existing business risks or speculate on currencies, because currencies have gone from levels of rational overvaluation into extremes. Swiss franc, great example. Anyone buying recently in Switzerland will know that unless they've taken some action, it's getting very expensive. The Australian dollar is arguably the world's most favourite commodity currency at the moment. And I thought I'd put up a chart just comparing the currency compared to the US dollar in green and the purchasing parity line, which is the red. PPP is just the sort of fair value of where the currencies should go over time. And what you can see is that it is its most overvalued for a number of years, 40 years. It's 40% overvalued, in fact. And the chart on the bottom just really is showing the deviation of a currency against its purchasing power parity. Now, we're not about to tell you that it's time to short the Australian dollar, but we would say that it is technically very overvalued, although as long as Bernanke is keeping interest rates at a super low level, it is likely to continue to fuel this commodity boom and currencies that go with that. But what I keep hearing is that it's different, Richard. It's a new regime. And that always makes me worried. So I just thought I'd throw that out there. Bonds, and another sort of cost that I know, as from the questions, people are interested in. This is about, I think, the most important aspect of what businesses are going to have to deal with in the future. And again, when it comes to stock market appreciation, it is quite clear that companies are being given a premium if they are not hugely indebted. That doesn't mean the debt and high yield and leverage loans aren't going up in value as people get more comfortable about life. But from a stock market perspective, it is interesting that companies that don't have a lot of debt are being sought after. And this is a chart just showing the US 20-year bond. I could show the same chart for the gilt market or the European bond market. It really shows, hopefully quite clearly, a marked decline in bond yields since the early 80s. Volcker came in and started imposing his anti-inflationary policies. And we've seen a wonderful declining disinflationary environment, which has been hugely productive for business in general, for property hugely, for equities obviously, and for bonds definitely. The blue line is the real inflation-adjusted bond yield, and we think that goes down as inflation picks up. But what's interesting is that that tram line that I've put across the green line is very much being tested at the moment after 30 years. Now, we would argue this is an inflection point in the making. It's impossible for me to sit here and say next month it's going to go through it and we're going to be up to 5% on the 10-year or the 20-year or whatever. But I think it's worth focusing for those people that have got debt or intend to finance future business with debt about the considerations, because I hear, again, people very complacent about the low levels of debt that they can borrow against. We are seeing a few people over the last several months beginning to lock in low interest rates. Some of the smart people that we talk to have done interest rate swaps and are locking in very good levels, historically extremely good levels of finance for the future. Companies we know are refinancing, they're paying down expensive debt, they're taking out cheaper debt after this improvement in sentiment towards debt. And again, it's not for me to say when this breaks, but sooner or later the bond market's going to rebel, I think, against the QE2, QE3, QE4, whatever we have to get to, and I think it's going to be ugly. What people forget in the bond market is that there have been many decades where people have lost money in real terms, and quite a lot of money. And I think the last, certainly 20 years, has been nirvana for the bonds. And this has huge implications for investment portfolios, which I wasn't going to get into. I was thinking more from a business perspective. But just for a second on that, people with a very conservative investment profile have had a ton of this stuff, fixed income of one sort or another. They're going to have to realize that is not as safe as it used to be, and they're going to have to rethink what they want and what they can expect. Actually, I'll skip that. There was one more question that I thought I'd ask just before I get on to my last slide. So if we've got that, I could ask you just to rank again for those businesses that have got some international presence. Where are you seeing the biggest contribution to growth in your business currently? Domestic, and that's an assumption that you're UK domestic, continental Europe, USA, Asia ex-Japan, or emerging markets? That's probably about it. So, okay, so there's a heavy UK domestic growth, which is great, because I think a lot of people outside the UK are supportive of the UK. A lot of people inside the UK are I hear, less enthusiastic, so it's good there's some growth coming from the UK. Emerging markets, not surprising. I was expecting to see the emerging markets a little bit higher, but the point I was going to make on my next slide is that there are huge opportunities. It's now the case that half of the earnings from the big American companies come from overseas. Much of that is from the emerging markets. And the makeup in the world stock market is very different to the makeup in the world's GDP. What I've shown here is the share of GDP in the green reasonably recent data, and you can see that it is a relatively level playing field between emerging markets, which are now the dominant contributor to GDP, North America, which was 40% of world's GDP only 25 years ago, is now 25%, European Union about the same, and Asia ex-Japan, and Japan continues to decline, although it's still a significant presence. The stock market, for those that are interested, sees it rather differently, and the stock market focuses more on the US. Now, there are reasons why the emerging markets are a much lower contributor to the overall stock market capitalization. Some of that's free float and so on, but there is an imbalance here. And I think when it comes to investments, from a non-business perspective, we are very focused on making sure that there is a move towards the GDP. We can never go as high as that because a lot of these emerging markets are uninvestable. They don't have mature stock markets or even reliable stock markets. But the point I'm saying is that, one, again, the stock market is paying a lot of attention to companies who are growing in the emerging markets. There are companies that I used to follow 20 years ago as an analyst who back then used to have 5 or 7% of their sales in emerging markets, and people still used to talk about the emerging markets as their growth component. Nowadays, those companies have 40%, and it is beginning to move their barometer. So ironically, those companies are going to see an improvement in their wherewithal. They're going to see an improved rating in the stock market. It's going to be great for their dividend flow and so on. And I think that's certainly of interest to our investors and probably not uninteresting to businesses. And again, a lot of our clients, when we talk to them, are spending more and more of their time in emerging markets. Yes, there's political risk. Yes, there's currency risk that needs to be taken care of, and plenty of other risks to go with it. But I thought it was interesting, and I wanted to share that with you. That brings me pretty much to the end of what I wanted to say. I guess in summary, the world is still a very imbalanced place, and there are lots of challenges and lots of opportunities. There is a polarization of wealth across nations. We are seeing the ongoing move between west to east. I view it as a baton pass, a running race. The baton's going to get dropped a few times before it firmly gets there, and we're in that sort of fumbling period at handover at the moment. But it is an unambiguous and necessary sluggish growth that awaits the West, and a much faster growth that awaits emerging markets in the longer term. It's a polarization of wealth for individuals as well. It is undoubtedly the case that LVMH has not seen any slowdown whatsoever in sales of its goods, and yet people trying to sell to your lower income level of customer are really struggling. So, when you go and try and find a restaurant still open in Dublin, it's hard. They're all shutting. And yet the business is booming for BMW sales in half of these countries that 10 years ago they weren't even present in. Quite extraordinary. Higher commodity costs, I think, are here to stay. That acts, unfortunately, as a huge tax drag on the West. So if you want to hedge against it, maybe own some, or at least if you've got costs that are related to it, think about hedging some. There's huge question marks over countries that are going through this government turmoil in Egypt, in Syria, Libya, and so on. I think there's a huge complacency potentially over that. We've seen oil rally up on the back of that unrest. It's coming back at the minute. I think oil is a natural hedge against that, and again, is a big input price for a lot of countries and individual businesses. And the emerging market consumer story is not a dream. It is happening. People are getting to that per capita GDP of GDP income that is beginning to filter through into purchases of mundane items that you and I take for granted, and it's impacting the bottom line of businesses, and there is lots of growth coming through, and we see it every day. So I think the final message is that if inflation is a present threat in the future, or sorry, that's not oxymoron, isn't a threat for the future, or is a threat for the future, then investing in real assets or shares in companies that own real assets has got to be one of the biggest parts of the solutions. You all do that, and therefore I think from that perspective, keep investing in those real assets, and I think you'll be in good shape. Thank you very much.